Hey, what's up guys? Welcome to another episode of Investment Bank Trading Strategies. In this series, we're going to talk about all the popular trading strategies among the investment bank traders. Let's get right into it.
So the topic for today is Iron Condor. As always, let's start with definition. What is an Iron Condor? An Iron Condor is an option trading strategy consisting of 2 puts, 1 long and 1 short, and 2 calls, also 1 long and 1 short, and 4 different strike prices, all with the same expiration date. So the structure of this trading strategy is that you need to buy an OTM call with a strike price of A and sell an OTM or ATM call with a strike price of B, where A is greater than B and B is greater than or equal to the spot price of the underlying stock. On the other side, you need to buy an OTM put with strike price C and sell an OTM or ATM put with a strike price of D, where C is less than D and D is less than or equal to the spot price of the underlying stock. Wait a minute, doesn't this look familiar to you? Of course it does. This is basically just shorting a bull call spread and the bear put spread at the same time. Now this is the payoff diagram for Iron Condor. You can see from this diagram that the maximum profit and the maximum loss are both limited. And the maximum profit that you can gain from this strategy is the premium that you collected from buy and sell those 4 options. And the maximum loss that you can get from this strategy is when the stock price goes above or below the highest or the lowest strike price of your call option or put options. You'll get the maximum profit when the underlying assets is trading in the range bounded by the 2 strike price which you set that is the closest to the spot price of the underlying asset when you execute a trade. It might sound confusing, I know. Now let's use a real life example to help you understand this. This is a screenshot that I took from Yahoo Finance, which shows the spot price for our best friend SPY and its call and put option trades. Now let's use the highlighted options to construct the Iron Condor strategy. How are we going to do that? First of all, the spot price of SPY is $446. For the call side, you need to sell the call option with the strike price $450 and buy the call option with the strike price of $452. And on the put side, you need to sell the put option with the strike price $442 and buy the put option with a strike price of $440. Now let's look at the payoff. On January 2021, on the expiration date, if the share price of SPY closes between $442 per share and $450 per share, then you get the maximum gain, which is the premium from selling options minus the premiums of buying options, which you get $1.56 per share. And if SPY closes below $440, or closes above $452, you will lose 44 cents per share. Remember, this strategy is basically shorting a bull call spread and a bear put spread. The maximum profit you can make is when the stock price closes between these 2 spreads, and the maximum loss happens when the stock closes outside of these spreads. And now let's look at the risks of this trading strategy. These are the screenshots that I took from my broker. It's basically the 4 option contracts that we used in our example. On the call side, remember we sold the $450 call and bought the $452 call. Some of the Greeks, delta, gamma, theta, vega, and rho, are neutralized. Same thing as the puts. Remember we've sold the 442 puts and bought the 440 puts. So the same thing happens, some of the Greek letters cancel each other out. So this strategy has a relatively low risk comparing to bull and bear spreads or selling naked call or puts, because the risks of these 4 contracts would partly cancel each other out. So when do you use this strategy? You should use this strategy when you believe the underlying asset price is going to be trading in a range, and also the implied volatility is going to decrease. Meaning that your expectation for the price of the stock is that it won't go anywhere, it'll just trade flat. or trading in a range bouncing up or down. So this is not a directional bet because you're actually betting the stock to be trading flat for a certain period of time. However, if you expect the stock to trend up or trend down, do not use this strategy. That's the basics about the Iron Condor option trading strategy. Hopefully it can help you to make some alpha in your future trading.
If you like this video and wish to see more contents like this, please like and subscribe. Thank you very much for watching, and I'll see you next time.